There's a bill which is now through the House. It is now with the Senate. That bill, as it's currently drafted, would bring back 100% bonus depreciation. Easiest way we can illustrate this is if a taxpayer goes out and buys a $10 million aircraft right now, and we have 40% bonus depreciation, they get to take a $4 million deduction.
Year one.
Year one. If this new bill passes, they can depreciate the full $10 million basis in the plane right away in year one.
Nice.
So the tax savings is substantially higher in year one.
Welcome to Own the Jet by Aspen Aero Group, where we share perspectives from some of the leading voices in private jet ownership and business aviation. I'm your host, Derek Savage, along with my co-host, Jason Spoor, president of Aspen Aero Group. Our guest today is KJ McCarter from Aviation Tax Consultants. KJ specializes in tax planning for private jet owners and companies, helping clients maximize their deductions and minimize their liability. Join us as we dive deep into the mechanics, mindset, and moments that define jet ownership. And together, we'll learn what it takes to own the jet.
Well, thanks for joining us, KJ.
Yeah, absolutely. Thank you guys for having me.
So can you tell me a little bit about why somebody would need to reach out to an aviation-specific CPA? I'm playing the role of a rich guy. I'm going to buy a jet. I have a CPA. Why do I need to have somebody that's aviation-specific?
Excellent question. And the answer is this area of the tax code is very nuanced and specific just to aircraft. So no matter how good your normal CPA is, they probably haven't dealt with any or very many aircraft before. So they may not be familiar with, one, the sales and use tax planning involved with an aircraft transaction, but especially the income tax planning involved with an aircraft transaction. Because aircraft are different than another asset that a business owner has purchased in the past. They can be used for personal use. So when a business owner buys a construction crane, that's relatively straightforward to account for. You can't use a construction crane for fun, right?
Right.
But a plane.
Well, I don't know. I
shouldn't say that.
I'll take on that challenge.
But in aircraft, there's certainly a personal use element to it.
Sure.
So it's different than other assets that CPA may have accounted for, and that's where our expertise can be really valuable.
You almost can't have one just for business, right? I mean, you gotta do something
somewhere,
with it, right?
Right. Yeah, almost all of our clients will have some personal use for the aircraft, and that's actually a common misconception or a common question that we get is, if I buy this aircraft and I put it in my business, do I have to fly 100% of the time for business? Or can I take a vacation flight with the plane?
Because that's the way they look at cars, right?
Exactly.
They're just like, hey, how much of this is business use? How do you log your miles? All that stuff.
Yep. And with the plane, it's similar to a car. It can be prorated. And the IRS actually gives us specific rules to follow for how to calculate what should be deductible and what should not be deductible based on that business versus entertainment use breakdown. So you absolutely can use the plane for personal and own it in your business.
What if you're a public company?
Public company, those rules can vary. So it's important that they talk to their tax advisors. We mostly deal with non-public companies in our practice, but the rule set is different there.
Yeah.
What are some things that if I'm owning a jet, right, or if I'm planning on buying a jet, what are some things that I need to know about the tax implications of that? Because we were talking earlier about some stuff where it's like where you do the thing makes a difference and timing makes a difference. There's all kinds of like potential landmines that someone like me would not know about.
Yep. Yeah.
What are the big ones?
The high level topics to be evaluated before an aircraft transaction. And that's a key point. This should be done before you close on the aircraft. Yeah. Optimally well ahead of closing. Okay. But closing location matters. So the aircraft needs to be sitting in a sales tax friendly location when closing occurs. There's a number of states that can meet that criteria.
And it's on a state-by-state basis?
State-by-state basis, okay. Correct.
Based on that state's laws?
Yes, based on that state's laws. There's some states that don't have sales and use tax, so those can work well. Okay. There's other states that have what we call a flyaway exemption, meaning you can close there, pick up the plane and leave, and because you're not basing the plane there, using the plane there, they don't impose sales tax on that transaction. Mm-hmm. There's a lot of states that have that exemption. So closing location does matter, but the more, not important, but typically a little bit more involved part of the planning is called use tax planning.
Okay.
And that concept is when the plane returns home to where it's going to be based, hangared, and utilized, that state can impose use tax on the aircraft. Right. And use tax is kind of brother, sister with sales tax. Okay. It's that one-time upfront tax on the purchase price of the plane. So like a California-based buyer, for example, If they bought a plane and they closed in Montana,
Okay.
that's great. Montana doesn't have sales tax, but when they bring the plane back to California, California would like to impose use tax on the aircraft.
Okay.
So roughly 10% typically
Wow.
upfront on the purchase price of the aircraft, and that can catch a lot of buyers off guard. So it's very important that buyers understand, even if you close in a sales tax friendly spot, you still have a use tax obligation unless you meet some sort of exemption.
What kind of thing would you have to do to meet an exemption?
Varies widely from state to state. So California, for example, and this is unique to California,
Yeah.
they have what we call an interstate commerce exemption. It's one of the main exemptions that taxpayers can potentially qualify for that involves utilizing the aircraft for out-of-state business use. Every state is different, though. Texas has its own exemptions. Florida has its own exemptions. The most important thing that the buyer needs to do is connect with the aviation tax planner to explain to them, hey, here's the plane I'm buying. I'm going to base it in this state or these states if they're basing it in multiple states, and come up with a game plan. And this goes back to what we were discussing about the buyer already has their normal CPA.
Yeah.
But their normal CPA probably doesn't know about the sales and use tax exemptions for aircraft in all 50 states. So that's part of the value that we can bring.
Yeah.
Jason, you work in the brokerage of aircraft, of jets. What are some things that you'd be like, oh shit, we can't land here and do business here, that you'd want to call KJ and make sure that
Yeah.
that was
The biggest is the closing.
Yeah.
We want to make sure that the client, the buyer, is closing that airplane in a state that is going to be good for them. Again, that's where he comes in to say, okay, looking at their accounting and how the taxes work, we would like to close in Montana.
And to be clear, too, that doesn't mean that the buyer has to try to track down a plane that's currently in a tax-friendly state.
Well, because I know that's what I'm like, okay, if I'm in Dallas, do I only shop for planes in Montana now?
Yeah.
Like,
Yeah.
how many planes
Just
are in
the-
Montana?
Go ahead, KJ, the plane.
Yeah, so the aircraft can be anywhere. And really, when we're determining where the aircraft should be positioned when closing occurs, we'll actually base that on where it's going for its pre-buy inspection, typically.
Okay.
So we want to pick the most operationally convenient spot that is still tax-friendly. So let's say the buyer tracks down a plane that they'd like to acquire, and it's sitting in a state that doesn't have an exemption from sales tax, and the pre-purchase inspection is going to occur there as well. That's fine. The aircraft just needs to be repositioned before closing would occur.
Okay, I'm going to test your knowledge. Oklahoma, good place or bad place?
It depends. So they have a flyaway exemption,
Okay.
but the aircraft has to be above a certain purchase price in order for that flyaway exemption to apply.
Okay, lightning round. Let's keep going. Michigan.
Michigan has a flyaway exemption. However, both parties need to be out-of-state parties. So its flyaway exemption is a little bit more limited than other states.
California.
California has a flyaway exemption. However, one of its requirements is that the aircraft cannot come back to California for 12 months following closing. So that's it. Generally, we prefer not to use it. We want to leave that option open for the taxpayer.
This guy's good.
Yeah.
We get a lot of practice.
lightning round.
Yeah. Do I care as much if I'm selling it? Do these things affect me?
Good question. Generally, the obligation for sales tax falls on the buyer.
Okay.
So it's not generally not the seller's problem. However, in some cases it can be.
Yeah.
Especially if the seller has a dealer's license or a sales tax account. Let's say they live in Florida and they have a Florida sales tax account. They may have obligation to collect Florida sales tax from the buyer when they sell it to them, unless the buyer presents them with evidence of an exemption. So sellers do need to be aware of that. They need to make sure they don't have some obligation to collect, and if they do, collect evidence from the buyer of a sales tax exemption being met. But generally, it falls on the buyer.
Gotcha. Jason,
I
you
was
had something?
Yeah, moving into depreciation.
Yeah. So exciting news on that front is there's a bill which is now through the House. It is now with the Senate.
Yep.
That bill, as it's currently drafted, would bring back 100% bonus depreciation from January 20th, 2025 through
If purchased
2029.
by-
If purchased after that date, on or after that date, through 2029, which currently we have 40% bonus depreciation. So it's a huge jump. And why that matters is, one, the tax savings that provides in year one for an aircraft purchaser is far more substantial, 60% more substantial almost.
Okay.
So easiest way we can illustrate this is if a taxpayer goes out and buys a $10 million aircraft right now,
Right.
and we have 40% bonus depreciation.
Yep.
They get to take a $4 million deduction
Year one.
year one plus the first year of 5-year maker. So a little bit over 40%.
Okay.
If this new bill passes, they can depreciate the full $10 million basis in the plane right away in year one.
Nice.
So the tax savings is substantially higher in year one.
Now, Jason, with your business, you talk about once a plane's been depreciated, that might be an impetus to sell.
Yeah.
So what does that mean in terms of the velocity of people potentially upgrading?
High.
If they can,
Yeah.
right, if they can depreciate the entire thing year one,
Yeah.
and then the next year, they're like, you know what? We had another good year. What else is out there?
Yep. Go bigger. Yep.
Yeah. It sounds like to me that this is going to open up the floodgates on aviation transactions.
Yeah, it should incentivize some first-time buyers to come into the space and get a substantial tax benefit in 2025. But also it can free up current aircraft owners to upgrade. And the reason that it may do that is we don't have like-kind exchange for aircraft right now, like we have with real estate. So when you sell, let's say an aircraft owner owns a $10 million aircraft,
Right.
and they sell it for $10 million.
Right.
They have to recognize, and let's assume they fully depreciated the plane, so their base is in at 0. They have $10 million of income from that sale in 2025. When we have 40% bonus depreciation, when they go and buy their next plane, let's say that's also a $10 million aircraft, and they take 40% bonus, they just got a $4 million deduction, but that cannot fully offset the $10 million of ordinary income from the sale of the previous aircraft.
Right.
We have $6 million left over, is the napkin math.
Right.
That we have to pay tax on.
Yeah.
That's suboptimal, obviously.
Right.
When we get 100% bonus depreciation back, now we can take the full $10 million deduction on the next aircraft in 2025 and offset the $10 million of income from the sale of the previous aircraft. Those net out.
As
It's a net
long as
zero.
you do it in the same year, right?
In the same tax year. Right.
Yeah. Okay. That's so that's the way the game is played, apparently.
Yeah. Yeah.
Yep.
Nice. Now there's the way the bill is written currently. That expires. So can you talk about that?
Yeah, as the bill's currently drafted, it's set to expire at the end of 2029. Now, things may change before this bill is enacted, before it gets through the Senate, or they may change in a couple of years. There may be a new tax bill. But for now, that's set to expire in 2029.
I mean, it sounds like there hasn't been a better time in a little while to do this outside of maybe just post-COVID, right? Whenever everybody was buying and selling. But this sounds like a good time to be thinking about it.
Yeah, absolutely. And it's certainly not a certainty that this bill gets through, but there's a ton of optimism in our space that 100% bonus in some way, shape, or form will be back for 2025. So it's a good climate.
So if I were a shady individual, I'm not saying I am, but if I were, and I wanted to avoid paying taxes altogether, I don't have to try to do anything shady. I just have to wait.
Just wait.
Is that kind of what it is?
Well,
Yeah, if you want certainty that you can take 100% bonus
Sure.
in 2025, if you want 100% certainty, you would have to wait to acquire until this bill gets through. And the latest that I've heard is the target date to get this enacted would be July or August. But Jason can speak more to this than I can. If you wait until September and then you say, oh, the bill got through, let's get started with an aircraft acquisition, you're very late to the game.
yeah. Probably not going to happen.
It's probably not going to happen in 2025, or at a minimum, it'll be a rush. So it's important to get started now with an aircraft acquisition if you're hoping to close before the end of 2025.
Is there anything that might go awry with any of the stuff where you mentioned all the potentials here, but what does somebody's situation have to be in order to take maximum advantage of this? Do they have to have a bunch of cash on hand? Do they have to have a certain asset mix, whatever?
Generally, they need to be a business owner, and they need to be able to fly the plane around for business use in relation to that business that they own.
Gotcha.
So the kind of slam dunk client fact pattern for us would be a construction company or a consulting company that needs to acquire an aircraft to fly around and meet with its clients or go to its job sites, and it's using the plane as an internal business use tool to facilitate earning its revenues. So the plane is not a profit center for them. They're not leasing it out to their portfolio of companies. They're just using the plane as an internal tool to get around and facilitate their deal making.
So if I own Acme Construction Company, does Acme Construction Company own the plane, or Is it Plane Co. owns the plane and then the construction company leases it off of plane? Like, what does that look like? What are the, I know there's a lot of like shell games that you can play.
Excellent question. And the answer depends on the sales and use tax planning involved, typically. So from an income tax perspective, if Acme is using the plane for its business use, generally Acme owning the plane could actually work from an income tax perspective. It can be as simple as that. However, you'll very seldom see that structure be used in practice for a number of reasons. Some are not tax related, but the main tax one is many times for sales and use tax planning purposes, we need a separate entity to own the aircraft. So that it can serve as the lessor of the aircraft and lease the plane from Plane Co. to the construction company. And the reason why that matters is sales tax can in some states be paid on lease revenue rather than upfront on the purchase price of the plane.
Oh, nice.
So take Indiana, for example, perfect example. If you went out and bought a $10 million aircraft in Indiana, let's say you didn't work with the tax advisor at all, you just went out and bought it. Indiana would impose 7% use tax on the plane.
Okay.
So that would be $700,000 tax liability on a $10 million aircraft. With proper planning, the aircraft can be leased from Plane Co. to Construction Co. in this example. That 7% can be paid over time on lease revenue.
Is Plane Co. like in Montana or Delaware?
No, Plane Co. can be an Indiana LLC. It could be a Montana LLC or Delaware LLC. It actually doesn't really impact what we're doing. So sometimes our clients will have out-of-state LLCs for some non-tax reason, but for tax purposes, it can be an Indiana LLC. That entity will have an Indiana sales tax account, so it'll be registered here anyway.
Right. And how much, just napkin math, how much kind of like savings could you expect just by doing the right paperwork, having the right timing, consulting with someone such as yourself?
Yes.
That would be able to help understand all of that.
Yeah, generally in Indiana, it's about a 13-year break even.
Yeah.
So the amount of sales tax you would have paid on lease revenue compared to what you would have paid up front will be the same after 13 years. So you'd pay about 1/13 of $700,000 per year in sales tax on lease revenue. And the real beauty of that in Indiana and states like Indiana is if you sell the plane after 4 years, for example, then you've paid 4/13 of what you would have paid up front.
Right.
So the remaining 9/13 stays with you when you sell the aircraft.
The bottom line from my perspective, what I'm hearing is if you are even remotely interested in owning a jet, you need to have this stuff figured out prior to even talking to anybody about a transaction. Is that how far in advance do we need to?
Really, the earlier the better.
Yeah.
To get started with tax planning and at least kind of table that. If all the tax answers are good, then they can set that aside and we can revisit, 3 months ahead of closing. But it's good to get those questions addressed well ahead of closing. One, so we have a game plan in place when we do find the plane we want to buy and we can move quickly.
Yeah.
But also if there's something that would prohibit them from taking income tax deductions on the plane, they probably want to know that sooner rather than later, right? So best to get those answers as early as possible. And we're always happy to have consultations. With the way that our firm works, we do calls early on in that process. We don't need to be engaged 2 years before we buy a plane, or if we're just exploring the opportunity to buy a plane. We have those calls all the time. We're kind of an open book with answering questions so that buyers know if they can take deductions on the plane.
Nice. And Jason, as a broker, that's something that's top of mind for you at all times is like, how do I make sure that my client is getting the best transaction, right?
Absolutely.
Yeah. So
yeah.
You would reach out early on in the conversation with your client about the tax stuff.
Yep, that and financing, but steering it back, towards the Part 135, Part 91 world, as far as setup and structure. What are your thoughts on that as far as how to go about it?
Yeah, so from a tax perspective, if it's just the taxpayer flying around in their own aircraft, that flight being operated under Part 91 or Part 135 won't change anything from a tax perspective on the income tax side. Mm-hmm. In a few states, there may be some personal property tax benefits of operating under Part 135, but generally speaking, it's the same if it's the taxpayer flying on their own aircraft. Now, if the aircraft is being leased to a charter company, for example, for charter to the public, that's business use, of course, but that's treated a little bit differently than internal business use by the taxpayer for their own business. So certainly if that's a part of the game plan for the aircraft purchaser, we need to discuss that ahead of purchase as well. And that can open the door to some sales and use tax exemptions as well.
So companies like quarter share, So you own a quarter of the airplane. They're paying tax on that?
Well, it kind of depends on the fact pattern, but generally speaking, if we go out and we buy a fractional interest in an aircraft, we can derive a similar income tax benefit to if we bought an aircraft for the same purchase price. So let's say we buy a share for $2 million instead of buying a $2 million whole aircraft, and we fly at 100% for business, both of them. Then we get the same depreciation benefit either way. Yeah. The sales and use tax planning involved typically is there's less for a fractional interest than a whole aircraft ownership.
Right. Makes sense.
Awesome. So how can people reach out to you if they are in the process of like, hey, I really think I'm ready to start the conversation of owning a jet, and this is something that I need to be thinking about, potentially setting up my own plane co. or whatever?
Yeah, our website is Aviation Tax Consultants. My email is kj@aviationtaxconsultants.com. Reach out anytime. Like I said, we're happy to hop on a call. We don't have an hourly fee or anything like that. We'll get on the phone. We'll answer your questions. If it makes sense to engage us, we can talk about that. But we're happy to be a resource.
We'll definitely have you back. There's like a ton of other questions I want to know, but it's like I feel like we're abusing your knowledge at this point, right?
I'd love to come back anytime.
Awesome. Well, thank you.
Thank you for watching Own the Jet. If you want to see more Own the Jet, make sure to subscribe to our channel on YouTube and leave a comment telling us what aspect of jet ownership you'd like to know more about. Own the Jet is brought to you by Aspen Aero Group, your trusted partner in private and corporate jet ownership. Learn more at aspenaerogroup.com. This has been a Savage Media production.